come to part 2 of our risk assessment lecture. So remember, in part 1 we introduced the concept of risk assessment, why we perform risk assessment, and how to identify risk of material misstatements. In this second part, we are going to focus more on the exam technique on describing audit risks. So one of the biggest things that you are going to notice is that identifying the trigger is not your biggest problem, but now converting the trigger into a properly worded risk is one thing that you need to focus on and practice and fine-tune. So for a properly worded risk, what are we going to be looking for? The first thing that we need to see is, what is the possible effect of the risk on the financial statement? That is, how will the risk result in the misstatement of the financial statements? I'll give you an example. Let's say the risk trigger that I picked is the company is newly listed on the ZSE. So what is the impact? Because they are newly listed, there's a risk that they may fail to comply with the ZSE reporting requirements. So by failing to comply with the ZSE reporting requirements, that may result in the misstatement of the financial statements. And secondly, why do you think the risk exists? So this is largely driven by the trigger. So if you look at my example, why do I think that the company may fail to comply with the ZSE reporting requirements? Because they are newly listed. So a completely described risk should have both the risk trigger plus how it will result in the misstatement of the financial statements. Then when you are looking at a detection risk, it's more or less the same principles, but the only difference is here the impact I'm now worried about, the trigger that I have identified, how will it affect the auditor's ability to gather sufficient appropriate audit evidence? Plus, obviously, the risk trigger is driven by the scenario. And I'm sure, as you can see from this wording, what's fundamental is your ability to understand the information in the scenario or in the case study. Because the moment you are going to give us a risk which is not supported by a risk trigger in the scenario, chances are high that's not going to be a valid risk. So let's use an example. So about the construction business segment of Fakai Strong, that's our company, which contributed a profit of 130,000 US current year, and the prior year 89,000 in the year under review. The decrease in profitability of this business was caused by the shortages of foreign currency, as its major source of raw material is appropriate. So when I look at this information, it's going to give me both risk at overall and risk at assertion. So I'll look at the first trigger, decrease in profitability. What does it tell me? So my risk could be the decrease in profitability can be taken as a going concern indicator. So my risk would be read as follows: inappropriate use of the going concern basis of accounting. But why am I saying this? Given the decrease in profitability. So I've got the impact plus the trigger. Then for the risk at assertion level, what's also clear is these guys are importing their raw materials. So my issue here is incorrect exchange rates may be used to account for imported raw materials. So my issue is use of incorrect exchange rates trigger the importation of raw materials. So both risks we are consistent. What is the impact? What is the trigger? And trigger is derived from the case study. Then as part of the auditing process, there's a category of risk that is put as significant risk by auditors. So what is a significant risk? So to put it simply, a significant risk is a risk that requires special audit consideration. So in other words, the auditor is simply saying, I'm going to pay particular attention to these risks. And from an auditing performance perspective, what is the implication? So for all significant risks, the auditor is required to obtain an understanding of relevant controls around the risk or that mitigate the risk. So you need to go back to management and say, management, I picked out these risks of material misstatements that I feel are significant. Do you have any controls in place to mitigate these particular risks? So that is the major implication from an auditing perspective. Now, to summarize what we have been discussing, this is just a simple mind map which will allow you to give you a refresher of the key issues around risk assessment. Why do we perform risk assessment? What are the components of audit risk? At what level is risk assessment done? At accession and at overall. And what are the risk factors or indicators? How do you pick them from the case study? Once you've got all these things, how do you describe audit risks within an exam context or even in practice? Because you are going to notice that one of the biggest challenges or review notes that come through within audit practice come from poorly worded risks. And also from a general common student mistake. You will find most of us struggle with differentiating risks at overall and at accession level. So it means when you are going to be doing your practice or tutorial questions, you need to focus on, are you able to distinguish between the two? How then do you weight them? And for some of us, we then end up coming up with business risks and not risk of material misstatements. What is the difference? Business risk, the impact is on the operations of the company. Then risk of material misstatements, the impact is on the financial statements or financial statements elements. So the moment you come up with a risk which is just general and you're not clear how it then affects financial reporting, then most likely that's a business risk. And for others, failure to identify risk trigger from the scenario. So you come into the exam with the memory bank of predetermined risks and you expect just to download them during the examination. Chances are high you are going to get a 0 for doing that. Why? Because we would expect you to use the risk triggers as given in the scenario or is identified from the scenario. Then lastly, another big challenge is failing to properly describe risks. That is, come up with the trigger and the impact. And normally failure to describe audit risk, I would say, is also a byproduct of poor accounting knowledge. Because at times you do not know the specific accounting implication, you are also going to struggle with coming up with the specific impact on the financial statements. So if you are clueless on IFRS 15 revenue, it's going to be a problem for you to come up with specific risks on revenue, around revenue, recognition, measurement, disclosures, etc. But if you know the intricacies of the standard, you can come up with specific drill down points on possible risks that can arise on revenue. And this is where you find the student simply saying there's a risk that inventory may be materially misstated. Definitely that's not a valid risk. Give us the specifics. What exactly, how exactly could the misstatement have happened? Because by being specific, that is the only way auditors will also be able to come up with proper and specific audit procedures to respond to those particular risks. So next steps, please go to your module, read your course notes on risk assessment, attempt the online quiz that you are going to get on this topic, attempt to practice questions from the module, and from doing that whole exercise, identify the areas that you'll be struggling with and bring these to your physical contact sessions. But remember, the contact sessions, we want to deal with more with the problem that you'll be encountering as you are going to be doing your practice question, and focus on the application rather than the theories behind the topics. So I hope this session has been fruitful for you, and if you've got any questions, do feel free to contact members of the auditing team. We'll be more than happy to assist you on any areas that you're struggling with. Thank you very much for taking time to go through this video recording, and happy studying.